So with the S&P 500 within 1% of its all-time high on the 26th of July, it's perhaps worth considering just what is the case for US equity? How solid is it looking? Well, if you look at the macro drivers, actually, they're looking reasonably supportive. We did, of course, at the Federal Reserve's last meeting, see another quarter point cut put in. That's 50 basis points for the year thus far. And the market expectation is in their meeting next week that we'll see another quarter point cut. Market's currently factoring in about a 90% probability of that happening next week. Personally, I think that this is perhaps a little bit overblown, but as I say, that's what the market is thinking at the moment. In terms of the broader geopolitical landscape, once again, that's become a little bit more supportive over the last couple of weeks. On the 11th of October, President Trump announced a so-called Phase 1 trade deal with China. This was with a bit of a delay confirmed on the Chinese side, which is always nice to hear. There have been many false dawns in US-China trade over the last year or so, but you're even starting to get US administration hawks such as Robert Lighthizer, the US chief trade representative, saying that they're making progress. You've seen Liu He, the vice premier in China, and President Xi's main economic advisor, also confirming this, and you know, the end game at the moment seems to be some sort of signing or formalization of this Phase 1 agreement around about the time of the Asia Pacific Economic Cooperation Summit in Chile in mid-November. So you know, maybe next few weeks we'll see some of this nailed down in print. So you know, so far so good. What's going on? Bottom up, as they say. What's going on in the microeconomy? Well, of course, we're starting to plow through the US earnings season. We've only seen something like 14% of US companies report thus far, but this week is pretty heavy, so that number's going to build up quite quickly. Expectations going into the third quarter reporting season is actually been pretty low. If you look at where the market expectations were, they're expecting a decline of something like 4.5% in terms of earnings per share. Of the companies that reported thus far, you know, it's been about a 4% beat or so. So I mean, net, it's about, you know, flat-ish earnings. We have seen some companies which surprised to the upside. We've seen companies such as Apple, JP Morgan hit all-time highs, but we've also seen some disappointments as well. And I think perhaps crucially, we've seen guidance going into the fourth quarter 2019 and into 2020, perhaps looking a bit soft, and that's where perhaps you know, absence anything more concrete on the for instance US-China trade. Because obviously, in terms of interest rate expectations are already on the floor. I think it's very unlikely that the Fed's going to provide any upward surprise. So it's, you know, it's down to geopolitics again, I'm afraid. The bar is actually set pretty high for 2020. Yes, analysts have trimmed significantly their expectations for full year 2019. As I've always said on this program, there's always an element of bait and switch around earnings season. They set the bar low and then they say, hey, we've surprised. And it, you know, the way at the moment the earnings season in the US is panning out, you know, that could well be a repeat performance. But if you look at where analysts are positioned for next year, well, this time next year they're expecting earnings growth to pick up to about 13%, and that seems like a pretty big ask unless you've actually got a real de-escalation of US-China trade and a real pickup in the global economy. And of course, you know, that ain't going to turn on the point of a dime. It's going to take some time to regain momentum. Certainly at the moment, there are downside risks to growth forecasts. So anyway, in conclusion, I'd say yes, we've got a bit of a tailwind at the moment. Yes, that has largely been factored into prices. If you actually look at where we're getting these headlines on the S&P 500, there's a bit more of a defensive rotation that's been going on. But you know, as I said, we need to actually see something more tangible on China trade. Otherwise, those forecasts for next year that analysts are currently penciled in are going to be looking a bit vulnerable.